Thanks, Mark, and welcome to the afternoon sessions. Well, it's my great pleasure to share the stage with Chris Cuff. And Chris and I have known each other for over 30 years, both at a professional and a friendship level. So it's great to have Chris. Welcome, Chris.
Thanks, Graham.
Now, I'm going to give more of an introduction than you would normally expect. And I know you didn't come to listen to me, you came to listen to Chris. But I want to paint the context because Chris's journey in financial markets mirrors quite closely what has happened with both superannuation and funds management generally. So bear with me if I just give you this bit of extra background. So I first met Chris in about 1988 when at the State Bank where I was the Deputy Treasurer, Chris was the newly appointed CEO of what at that stage was called First State Fund Managers, which became Colonial First State, which all of you would know. And State Bank had decided that some of the money that was held by for the staff in a super fund would be good to have managed by a fund management business. And Chris became the CEO at the tender age of, 27, something like that? Yeah. And so it was part of the treasury operation, which I was involved with, and Chris used to come along to the weekly management meetings, and we would talk about interesting things like swaps and options and balance sheet and all those good banking things that treasury do. And Chris would talk about funds management. And I must say at that stage, I wasn't quite sure what it was. But Chris seemed to be super enthusiastic. And that few $100 million by 1991 became $1 billion. And I remember the $1 billion party, and that was like a big deal at that stage. And you may remember that then there was a big event in Australian financial markets history that in 1992, the compulsory superannuation, the superannuation guarantee was introduced in 1992, which became the catalyst for the rapid growth of the wealth management and superannuation industry. And Chris was at the vanguard of all of that. And what is not sort of widely remembered is that over the coming dozen years, that business involved the merger of probably 4 or 5 different wealth management businesses: Prudential, Legal and General, the Colonial Investment Management, Commonwealth Investment Management. So by the time Chris left in around 2003, this was the largest fund manager in Australia. It's really an extraordinary achievement to coordinate and merge all of those businesses. And every time one of those businesses merged, it was always the First State and Colonial First State, which was the dominant business under Chris. So Chris then went on to do other things, CEO of Challenger. Then he went to the other side of the business for a while as a board member, and then as the chairman of UniSuper, so retail and then UniSuper. And then in the last few years has been involved in a lot of philanthropic work and listed investment companies, but also in family offices. So it's really a fascinating journey that is all about the wealth management industry in Australia. And so there's really no better person to talk about the way the industry has changed. So the structure here is that we will talk about some of these investment lessons that Chris has learned over the years. But I thought I would kick off, Chris, by just saying, tell us what you're doing now.
Tell you what I'm doing now. Well, these days I work on with about 10 different groups, mainly in the investment management industry and the philanthropic industry. So the groups range in size from, I still sit on the investment committee of UniSuper, which is a $80 billion behemoth, a number of listed investment companies you mentioned, the investment committee of Paul Ramsay Foundation, the largest charitable foundation in Australia, a couple of family offices, and also I manage a couple of portfolios. And on the philanthropic side, which sort of touches on the investment side, I've been looking after a fund called Third Link Growth Fund, which is an Australian equity fund of funds for about a dozen years. I'm chairman of a listed company called Hearts and Minds Investments Limited, which is a global investing company that gives away a portion of its assets each year to medical research, and I founded and chair what is known as Australian Philanthropic Services. We have about 600 clients, and they're clients who take philanthropy quite seriously and want to learn about perhaps better ways to do it or more efficient ways to do it. So that's what that was set up for, Australian Philanthropic Services.
But you don't think of yourself as a fund manager or a stock picker, do you?
Not particularly, though. You know, I do some of that for myself and for some people. But in the main, I spent my career assessing fund managers, looking at what they're doing, what they're saying, what their results are, how they coordinate with each other, fees, conflicts, you name it. Anything about a fund manager is sort of what I spent my career doing, including when I was CEO of Colonial, First State and Challenger. I had a lot of fund managers reporting to me. So, you know, you got to know that space pretty well, and the lingo and some of the bullshit that goes with it. Excuse the French.
Yeah, you bet.
Yeah.
So a reminder to send in questions at any time if you want Chris to answer them. I'll try and leave some time at the end for that. But Chris, one of the most popular articles we've published in First Links was your article about the lessons you've learned over the years. If anyone wants to see the article itself, go to First Links, free to read. Just search for Chris Cuff and you'll find all his articles there. I'd just like to draw out some of those points now, and we'll discuss them individually. We probably won't get to all of them. But I'll just start with one of the points which is probably a little bit contrary to what is said in nearly every product disclosure statement in Australia, where it says past performance is no indicator of future performance. You're not very keen on that, are you?
No, I'm not particularly keen on that statement, because when you're trying to assess a fund manager, there's not a lot that you can rely on that you can say is absolute fact to start with. I mean, Graham and I were talking before this session. I've rarely heard a bad funds management presentation. Fund managers get up, tell you things, you think they're wonderful, and you know we should all jump to them. But it's not all roses. So when I'm looking at fund managers, yes, I want to see the past performance. I want to see it over different time periods, segments of those time periods. I want to see how volatile that performance might be. I want to see how that performance may line up to the things they're saying in their published literature. But very key to me too is when I look at a fund manager, I really am interested in long-term performance. That fund I mentioned before that I run myself, Third Link Growth Fund, once I put a manager in there, I will keep that manager there for a minimum of 3 years before I become more interested in the results.
Yeah.
And if I felt a change was required, it rarely happens before 5 years.
Right.
So that's pretty much the really important thing to me. Long-term performance is the key.
Yeah, and I sometimes say to people, if you're going to choose a manager, you can't make that a one-year decision. You know, if you think that you might be getting out after a year because they've underperformed, then you shouldn't even choose them, just because their style may not have worked for that time.
Exactly right. You know, fund managers, this is the game of funds management. I'm sure your audience would know it's not an exacting science. Fund managers have their good and bad days. It's perhaps like a cricketer and a cricketer's batting average. You would hope that a good fund manager can make more good decisions than bad, but believe me, they're going to make plenty of decisions that don't work out.
Yeah.
So you need enough time period, some people might call it cycles, to go through, or different stresses in the system, like, you know, in recent history, we've obviously had the COVID stresses of earlier this year with investing, and we've had GFC in the past, we've had recessions. You know, things change all the time. How does the manager respond during that is what I'm really interested in.
Yeah. And I know one of the things you've said in the past is don't pay active fees for index management. What's your main point there?
Well, the key point there is investors need to understand that most funds management businesses are actually businesses. They have many funds. There's shareholders there wanting a profit out of the end of this managing money. And a fund manager, in the main, that works for an institution will not be too game to be too different from whatever index their particular fund is being measured against. And I have this debate regularly with fund managers. I'm looking for active fund managers who really want to be different. And I ask people, you know, do you think you're different to the index? And many say, yes, of course I am. And then when you run down the individual figures, you know, well, what's your exposure to banks? You know, they might say, well, it's 20% and the index is 22%. Or what's your exposure to mining? Well, you know, it might be just a couple of percent off what the index is.
Yeah.
And they see that as active, when I don't see that as active at all. So you are, in essence, paying fees that are often for active funds management, but you are getting quite often a very benchmark-like performance. And no wonder passive investing has been growing in this country, where the fees are a whole lot lower. You know you're going to get the index. Yeah. It doesn't necessarily mean that's a great investment, but it's, you know, you pay for what you get rather than overpaying.
Yeah. And so if there is a fund manager who has a diversion from the index, they have the risk that they may underperform because the things they hold that are different from the index may not do very well. So you're saying that a lot of people avoid that business risk of being 5% below the index.
That's right. There's definitely time periods where, you know, some managers who might feel they've got the bravado to be quite different to the index, but, well, how long will you be different until it works? And sometimes good fund managers I follow, they can have a couple of pretty ordinary years in performance and then sort of shoot the lights out. But to do that, you need to be different from the index. That's your starting point. So yeah, one of my sort of secrets of investing, at least for myself, is I want managers who are definitely active, and I want them to prove they are active to me. And I've got the patience as an investor to ride out their tougher periods.
So I think this is when you've said, what is your expression? Swing the bat? Or
swing the bat.
Swing the bat.
Yeah, I want managers to get out and swing the bat. We know there's plenty of statistics to say that more than half of the fund managers or more active fund managers really don't come up with active results. Right. And no wonder if you're not trying to do it based on exactly what you think rather than how an index is constructed or the amount of risk your business can take. I mean, again, on the business risk side, if a fund manager underperforms a benchmark for a couple of years in a row, that could lead to very material outflow of funds, and that means a very material drop in revenue and probably profitability coming from that fund. So it's a big deal.
Yeah. And in this selection process with fund managers, how much does the quantity of funds that they are holding and your view of the capacity matter, perhaps by asset class?
Oh, it matters an awful lot. I think it's sort of glossed over a bit. And again, look, most fund managers will tell you, regardless of their fund size, the amount of funds they have, that they'll still be able to perform quite well. But look, in my mind, I think there are barriers you come up against with certain sizes of funds. So I would say, managing active Australian equities, I always think around sort of $4 to $5 billion. Right. Once a manager's at that level across all its particular Australian equity funds or mandates with big clients, it just gets harder to manage, harder to get into stocks, harder to get out of stocks, just because you're a larger part of the market. Same in the small companies area. I think the smaller company sector has a lot to offer for investors. I always have. But I'm pretty shy on any manager that is sort of $1 billion or more in that area.
In small companies?
Yeah. Just because it's so hard. Look, there are exceptions to the rule. There's some quite talented people who can manage larger amounts of money. But generally speaking, the larger amount of money you're managing, the more time you need to complete transactions, either get invested or get uninvested. And that's problematic. But there's other asset classes where size is your friend, such as fixed interest. I mean, find managers which are with as much as possible and with as many securities as possible, because your risks are very much different there and the markets are deeper there. I would also say with, say, a global large cap manager, size is not a big issue because across the world there's many, many very large cap companies to choose from.
Yeah, and I think what's sometimes overlooked is not only that in the market, the bid offer price or the buy and sell price can be divergent, but there's not much volume on either side. Do you want to comment particularly on what you see for listed investment companies when the liquidity falls away in that sector?
Well, yes, listed investment companies are all the topic now, as they were sort of a year ago, but for different reasons. People were pouring money into the listed investment companies, and now they're on the nose a bit. People really probably didn't appreciate enough that outside what's happening with the underlying investments in a listed investment company, you have an extra layer of supply and demand over the top of that. It doesn't matter how good your listed investment company is performing with its own assets, if there isn't enough buyers above that, then you don't get the right pressure on with the bid and offer, and these things can then trade at a discount. So $1 worth of assets you might be able to buy at 80 cents, and this is problematic. I think if you look back, that probably was not understood enough by people who invest in listed investment companies, that when markets are down or people are nervous, the buyers and sellers of the buyers of listed investment companies tend to disappear a bit.
Yeah, and another topic I've heard you talk about is performance fees, and I know a lot of people don't like performance fees. And unfortunately, the industry doesn't actually have a standard of what a performance fee is. How do you feel about them?
Well, I have mixed views. First of all, for managers I personally invest with who have performance fees, they've done extraordinarily well in the main, and I'm completely happy paying a performance fee. If I was paying a fee as high as, say, 20% of an outperformance of something, then that doesn't worry me because I get 80%. But what does worry me is most managers with a performance fee fee structure, there's a management fee as well. So you pay the ongoing management fee and then performance fee for what should be extraordinary performance. But it sort of begs the question, what's the management fee there for? So if the management fee was to just get you an index performance, and this, let's say it's an active fund with an active management fee, which are much higher, then if all you got was the index, then you haven't got a very good result for your management fee. And then yet often if the fund outperforms the index, the performance fee kicks in.
That's
so
right.
It's sort of, it doesn't add up too well when you think where these two should sit. So you need to look very carefully at what are the hurdles. The couple of funds I invest with, which are terrific funds, only have performance fees. They have no management fee.
Right.
They say if we don't perform, we don't get paid.
We don't eat. As fund manager, could probably tolerate that for a little while, but at some point they would have to pay the bills.
At some point they have to pay the bills. One of these particular managers I was talking about has their ongoing fee is still a performance fee, but they just say it's an advance on our performance fee.
Right.
So when we actually do perform, you get a credit for what we've paid you to date. So there's no sort of double dipping going on. But again, the two fees together, management fee, performance fee, is okay for some funds, but the hurdles have got to be right. They've got to be earning it rather than just gouging.
I think what a lot of people miss is that because there's no industry standard for performance fee, they just say there's a management fee and there's a performance fee, and that's sort of taken as they must be the same. But I remember when I used to be involved in the drafting of the offer documents at Colonial First State for fund managers, it was such a complicated section to write because sometimes the base fee was included, every one of the benchmarks was different, and it was really problematic sometimes. You even had equity funds over a cash benchmark, which was ridiculous. And I think at the moment what's common is you have some technology funds over a broad-based global index. And we all know technology is shooting the lights out. So some of these fund managers are collecting very large fees because they happen to be in a great sector at the time. So I think the message to people is don't just think a performance fee are all created equally.
Yep, I couldn't agree more, Graham, particularly when you look at performance fees that are set at any performance over cash, which is
pretty low.
which is was pretty low at the moment. But if you go to any textbook on investment management, it'll tell you generally that if you invest in equities, you should expect a premium over the risk-free rate of 4 to 6% per annum, and that's what history has delivered. So if you said you had a performance fee over cash, then you'd say the first 4 to 6% outperformance is just what the system's going to give you. It's a free lunch.
Yeah. You wrote an article for First Links recently, which was a part of the industry which I must say I didn't know that much about, and that's private debt. And I'm thinking one of the points that you've made generally is that the returns that you get don't always recognise the risk. And in your work with high net worths and family offices, this has become a part of the market you've been looking at more recently, I understand.
Yes, that's right. And so the general theme here is, again, if you open a textbook about investment management, there's this risk-return trade-off going on the whole time. And if a market is relatively efficient, that risk-return trade-off should be relatively efficient as well. If you buy into riskier, so-called riskier assets, you should expect a higher return, and the reverse. But I think there are genuine arbitrages that exist. And this area that you just mentioned, Graham, of private debt, it's one that I think is a genuine arbitrage. There's quite a few private debt funds now offering or expecting returns of sort of 7, 8, 9, 10% even, some even higher than that. And I think that the way those funds are invested are very good. But the catch is liquidity. You can't just put your money in and be able to get it out tomorrow. There are generally lock-up periods of you've got to be in for a minimum of 2 years or 3 years before you can start pulling your money out. And that might be an impediment to many people. But also for many investors, I would say, think about does everything really have to be liquid? You might have a portion of your assets which you say you can lock up for a number of years, and that's great. But that area of private debt has blossomed because the banking industry, the banks in Australia, have stopped lending to some sectors of the economy and some types of securities, and hence, this sort of almost dark or black market has come out of people lending to those that couldn't be lent to by a bank.
Right.
But just because a bank won't lend you doesn't mean you're not a good credit risk.
Yeah. So, Chris, we've got dozens of questions coming in, so we're definitely going to have a timing problem. I would like to just touch on a couple of the big issues first. Active versus passive, does the debate change by asset class? How do you feel about that?
It definitely does. Sometimes people just holistically say active versus passive like there's nothing in between. Personally, I think active investment management, if the fees are right and the people are swinging the bat, has a good place. But that would be, say, for Australian equities, particularly Australian small caps, I like that. But do you have to be, but there's some sectors in the fixed interest area where I think you can have a passive portfolio because fixed interest is completely different characteristics. It's more about the credit risk. You just want a lot of securities. It may not be quite the same need. As I said previously too, I think in international funds, I didn't say this exactly, but in international equity funds, I'm quite relaxed about having a fund that's more passive there because it's much broader investment universe to come from. Some people say I invest in Australian equities in an index fund, and I say, well, good for you. I think that's a highly risky strategy because the Australian equity market 40% of the market is the top 10 stocks. I think 55% of the market is the top 20 stocks, and there's a bunch of banks, a couple of miners, and CSL. But you don't get a huge lot of breadth in that, and I call that concentration risk.
Yeah, and if you look at the way most investors in Australia invest, it's a diversified fund, and it's commonly a 60-40, maybe 60% growth, 40% defensive. Then you get into this debate about what goes into those categories. What are your thoughts about the way the industry struggles with those categories, and particularly whether you think some of those have been compromised by COVID in the way you might feel about whether it's defensive or growth?
Yeah, well, the starting point there is, many of your listeners would know, yes, the industry is broadly talked about as growth assets, defensive assets, usually equities as growth assets, with property perhaps, maybe infrastructure as well, and your defensive assets, fixed interest securities, government bonds of the type. But that's a very, bit and bite classification. I never think of the world as just growth and defensive. In fact, I don't even like the word defensive, and I'll tell you for why in a second. I normally think of it as growth assets and income assets,
right,
with the distinction being where you expect the majority of their return to come from.
Yeah.
If I'm in a fixed interest security, even a private debt investment, I'm expecting most of the return to come from income in the nature of interest. But if I'm in an equity investment, well, I'm receiving dividends, but I'm expecting over time to get growth from the underlying investments, and hence growth versus income. So, but it's sort of when you only have two categories, and they're sort of, so everybody's got their mind, that's it, growth, defensive. I guess the average investor could think, well, if I've got a portion of my money in a defensive category, that must be good in bad times.
Right.
Because it's defensive.
You'd hope so, yeah.
You'd hope so. But when times are really stressed, and we've been through one of them recently, as we did 10 years ago with the global financial crisis, things that are classified in the defensive bucket can often have huge volatility, and indeed experience losses. So it's a lot of that depends on the time period as well, because you would have seen in mid-March and to the sort of into April, when we had the COVID, crisis so much, which affected the markets dropped significantly, but of course they recovered significantly post that. So, if a defensive asset recovered strongly, you might say, well, it still belongs there. But my point is, I don't think it's as black and white as just a safe bucket and a less safe bucket. And but even when people invest in those buckets, I said I run a fund, Third Link Growth Fund, which invests in other managers. Many people who have a profession of mixing managers together, I think they don't particularly do it in a great way either. I think they over-mix managers. I want a value manager and I want a growth manager in the portfolio, and I want a large cap and a small cap.
And you end up with the index.
And you end up with an index result, less the fees, and you scratch your head of saying, why did I get the index result?
Yeah.
Personally, I'm more interested in good managers. I don't really care on their style.
Look, this growth defensive is a challenge. If you look at the Australian government bond index at the moment, the duration of that is 8 years. So that means if interest rates were to rise 1%, the capital value of that index would fall, for that 1% rise in rates, would fall by 8%. Now, that's clearly a massive fall for a defensive asset. But I'm sure there would be bond managers who would say, yes, interest rates have risen, so you would invest your coupon and your principal that matures in a higher rate, and eventually you get your money back. But it just shows how complicated the debate is.
I think the debate's very complicated on that, and I watch the debate amongst seasoned professionals who, and even they can't find the consensus on that. So it's sort of caveat emptor when you look at anything that has these strong categories. Yeah.
So, apologies to people if we don't get to your question. So I'm just going to have to go through these fairly quickly, Chris. What are your thoughts on long-short funds, and why are they so expensive?
Well, long-short funds, when you may have first heard about them and you read the opening couple of sentences, you'd think this is a no-brainer.
No-brainer good.
A no-brainer good.
Yeah.
As in, I can invest in things that go up, and the fund manager's smart enough to find things that go down, so I'm going to make money both sides of the ledger. But long-short funds, I think, in the main, as a generalisation, have often disappointed people. It's harder than it looks to short stocks. I think that's the bottom line. When shorting a stock, obviously when you short a stock, you're hoping it's going to fall, and that's how you make your money. But the issue becomes, even for a bad company, it can take years for investors to lose confidence in it. So you're not just betting against the fundamentals of the stock, you're betting against investment sentiment, which can hold things up for a long, long time. I think long-short funds haven't been wonderful for everybody in the experience. And sometimes you can get the extraordinary thing where the long side does poorly and the short side does poorly.
Yeah.
Like the short side, the stocks you thought would go down, they've gone up. And on the long side, the stocks you thought would go up, or the fund manager thought would go up, go down.
Yeah.
So you actually get a double whammy. It's not straightforward.
Yeah. It looks as though it's market neutral, but it may not necessarily be so. Look, we said earlier that you're not specifically a stock picker, but this particular question has got the most votes, so I'll need to ask it. How will the US election affect Australian stocks and markets? And do you think there are certain sectors which will benefit from the outcome? But if you don't feel that's your best talent, we can leave it.
I don't think that's my best talent. I would have all I know is markets go up and markets go down. But what I do know is it is extraordinary how much the Australian market and the US market, equity markets, run in tandem over time. Not necessarily over each week, but you look at charts over a number of years or decades, and it's very consistent the way they run with each other, which often surprises me. So what I could say with some confidence is that I'm betting probably what happens in the American markets in reaction to the election, if there is a reaction, will probably be felt in the Australian markets, at least in the short term.
Yeah.
But we should also remember, just as a quick aside to that, the American indexes, stock market indexes, are so heavily influenced by just a handful of these huge technology companies now, which they're probably running quite independent of any election that's going on.
It's more concentrated than it's ever been in history.
Absolutely.
Yeah. So, Chris, you've seen a lot of funds management styles and investment methodologies. Is it possible to generalize about which you found is the most successful?
Well, the most successful I sort of probably hinted on before, with those managers who really have a strong conviction to invest independently of their index. Managers I've seen do a particularly good job, but they have the skill set on board, are managers who have the freedom to invest in both listed markets, unlisted markets, Australian markets or international markets. Some portfolios have that complete freedom, and if you're a fund manager that can feel you have the skill set to navigate those, and you're willing, and that means you are going to be different because there's not one index you're following there, you can see some pretty extraordinary returns. But it's generally been those managers I find that I've had the best long-term returns from are those who still have their periods where they don't do as well, and you've got to ride through those, I believe.
Yeah. So, Chris, how do you feel about deep value investing, which is generally, buying cheap stocks which are unpopular with the market?
Deep value investing, my experience over time is that it looks appealing, but very few managers actually succeed in it, because by its nature, deep value, you're buying something that looks cheap. But looks cheap compared to what? Often a stock is cheap for a reason. not just because it's fallen out of favour. Sometimes a stock can be cheap because it's thinly traded or whatever, but if there's something wrong with that stock, then it probably deserves to be cheap. But the problem is there's this expression of a lobster pot. You know, deep value investing like a lobster pot. You can easily buy the stock, but when you want to get out, if things aren't running in your favour, it's very hard to get out of these small stocks. And my experience is managers who have specialised in that area tend to get carted away by the passage of time. They ultimately could be right on their stock, but you had to wait 2 or 3 years before you saw that. And investors, as I've said before, generally don't have that type of time frame when investing. So it's tough going, deep value investing.
And you said earlier that you don't love blending styles, but obviously that's that happens a lot in the funds management industry. Could you elaborate on that one?
Yeah, look, I guess it's what are you trying to achieve again? I'll give an advertisement for my fund, Third Link Growth Fund. Its long-term performance, which is around the 10-year mark, is about 3.5% greater than the fund's benchmark, which is the ASX 300, and that's after fees. So a performance like that, that's a very strong performance in the funds management world. And I get that without much science. I get that from having dealt with many fund managers over, hate to say it now, it's becoming multiple decades, and I think I have a good idea of those I know of who are genuine money makers and who are not. So I don't really care if the fund end up having 10 value managers or 10 growth managers, as long as they can prove to me from their past performance and the way they've behaved that they really do have that IP, that intellectual ability to do better than a market over a reasonable time frame. So yeah, I don't really care on their size or their style. I just want to know in their niche.
Yeah, how good are they?
How good are they? Inevitably though, when you put a portfolio of 10 managers together, you'll probably get a few different ways of managing money anyhow, but I don't use that as the starting point.
Yeah. And another question here about gearing into equities. Interest rates are so low at the moment. What's your attitude to gearing?
Well, that's always an interesting thing. A good friend of mine who happens to be the Chief Investment Officer at UniSuper regularly reminds me that when things really get stressed, normally leverage is at the bottom of the stress. I'm talking about in financial markets. Leverage, gearing can often lead to really tough times for people. And look, you could say with interest rates so low, why wouldn't you gear? Well, I would say, well, why would you? What are you trying to achieve? What is your goal there? Interest rates might be low, but equity markets might stay static for a decade. Who knows? I mean, they've been valued so highly in the last couple of years, you sort of wonder how much more have we got to go here. But it just adds a stress to investing that I don't believe everybody needs. And there's a line there where it gets to greed. You just want to make more money as opposed to necessarily being smart. And if you look at people in those periods of time when markets have fallen and people have had gearing, you can see some serious angst going on. And interest rates won't always be low.
Yeah.
And no one's going to ring the bell when they just before they start to rise again.
No, that's right. It's unfortunate that.
It is unfortunate.
So look, when Mark introduced this session, he mentioned about First Links and the journey we've been on. So it would be remiss of me not to give a little bit of the background. So very briefly, in 2012, Chris and I were literally having a lunch. We were talking about wouldn't it be great if there was a forum where market professionals could write and we would moderate it and we would get these sort of expert opinions into the market. And Chris said, yeah, that sounds fantastic. It's fine if you do all of the work. And so we launched the business and I unashamedly built on Chris's name and reputation by calling it Cufflinks. And we had a great time. Chris was always guiding me and telling me what we should be writing about. And he contributed a lot of content as well. And then after 7 or 8 years of building a good audience and the way we wanted to do things, the business was acquired by Morningstar in 2019, and that's where I now work. But Chris, thanks for that journey. I enjoyed it tremendously, and it was always great to get your guidance as we went along.
It's a pleasure. It was great fun being part of it and knowing that, particularly through the Morningstar ownership, that it will probably exist forever.
Oh, forever, okay. So thanks very much, Chris. That's been a great session. We could talk about investing all day, but I can see Mark hovering in the wings, so we'd better exit stage right. Thank you. Thanks, everyone.
Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.